Ladies and gentlemen, welcome to your favorite podcast. This is Real Estate Investor MBA.com. We created Real Estate Investor MBA to leverage the knowledge of giants through synthesizing and providing much needed information to all investors, from the veteran investor to the new and aspiring investor. At Real Estate Investor MBA, we plan to cover pertinent information head-on with our expert guests who we will interview on what they are doing and preparing for in the days and years ahead. We aim to create MBA quality curriculum topics and themes from the information garnered among our interviewed guests in order to bring world-class value to our fellow community of listeners. We truly believe that rising water raises all ships, and by sharing this leveraged knowledge, we can create a stronger online community, which translates to stronger local, regional, and national communities. Your hosts are Jeremy Moyer, who is a veteran real estate investor and author of a new book called Are You Playing the Real Estate Game Blind? As well as Tejas Gosai, the owner of eXp Realty, the Tejas Gosai team, and also co-manager in a newly formed Regulation D private equity fund called the Lehigh Valley Private Equity Fund. Now let's get to the show. Hello, ladies and gentlemen. Welcome back to your favorite podcast. It's Real Estate Investor MBA, a program that Jeremy Moyer, my partner, and I came up with as a COVID project last year, and we've really enjoyed ourselves with all the guests, experts, a lot of knowledge being shared. We're up to 35 or 36 episodes.
That's right.
Yeah, thanks, Jeremy, for bringing our guests on. If you'd like to be on our program, please contact us. Our email information is available. And if there's any topics that you would like to learn about, we covered a lot, like cost segregation. We've talked to the mayor of Easton, and now is Matt Turek the mayor of Allentown now?
He will be soon. Yeah.
Okay, good. So we had Matt on before he ran for mayor, and hopefully that will shape up well. So we love what we're doing. Check us out on iTunes, Spotify, Stitcher, Google Play, Podomatic. We're all over. And yeah, we appreciate you. So Jeremy, let's bring on the guest.
Sounds great. So for the show today, we have George Antone with us. George is the author of 3 best-selling books, is a thought leader in the investing and finance space. He's also a founder of Finance LLC, a company that transforms people and investors into finance hackers, bringing them closer to their financial goals and more fulfilling lifestyle through education and software. George, thank you for joining us today and being on the show.
Thanks for having me, guys. I really appreciate it.
Absolutely. So before we jump into questions, can you just tell our listeners a little bit more about yourself?
Let's see. I started my life as a software engineer, worked at a number of software companies. The last one was at Intuit, where I worked on Quicken and a number of other Intuit's software. And in 2001, I walked away from an incredible corporate career, got into real estate investing and some other investments and stuff like that, and never looked back. So I haven't had a job in 20 years now. And so I've loved every minute, every second of it. And it's funny because I walked away from software, went full-time into investing. And then just now, after 20 years, I'm getting back into software because I want to take a lot of the things I've been doing and creating this AI stuff. We'll talk about it later, but it's just full circle. But that's how I got into real estate and started with buy and hold and rehabs and all that stuff, and got into multifamily and here I am.
Love it. Where are you from originally?
Lebanon. I'm originally Lebanese.
Bravo.
And in December 26, 1987, I arrived to LAX, expecting Brooke Shields to be waiting for me. The whole time on the plane, I'm visualizing her waiting for me on the airport. She wasn't there, but that's when I got to studied in California, in Northern California, computer science, and that's how I end up here.
It's awesome. Excited to hear.
Absolutely. Thanks for sharing that, George. So we are actually titling this episode ahead of time, which is a little different from how we normally do it. But we're titling this the number one unknown reason why most buy and hold investors lose their shirt. So I've had the pleasure of listening to George a few times speak. Tremendously knowledgeable on a ton of different topics. So George, I know one of the things that you encourage investors to focus on is the capital structure of the investment. Can you talk about what is a capital structure and why it's important to know what even it is?
I got to tell you, I see this mistake with most investors, and where most investors that lose their shirts are boils down to this one thing, which is capital structure. So, what is a capital structure? It simply is how something is financed. So, if I'm going to buy a property, how much debt and how much equity? That's simply a capital structure. However, it is so important that you know more about capital structure. So, if you think about a deal. Most people think the money side or the capital, and they think the asset side, right? So I'm going to get a mortgage, get this money, raise this money, put my savings, whatever, and buy this property. Okay. So they're thinking asset and capital, but the underlying thing, the third side of the triangle, is capital structures, which is how much debt should I have? How much equity should I have? All of that affects where people are. So why is it important? I can tell you with every certainty, most investors that have lost their shirts is because of capital structures. A lot of people say, well, the market went down, that's why I lost properties. And I tell them, no, the market will always go down in real estate. You have to know what to do, and that's part of the capital structure. So why is it important? Most people, I'll share a quick story. I met this young guy from Florida who had done everything right. He raised $1 million from friends and family, bought properties, did everything correctly. Whatever he did correctly. A few years later, he had lost all the properties and all the money. And this is family money. And everything he had done was correct, but he missed the idea of the capital structure. He used too much debt, he didn't have reserves, and he didn't know what to do when the market was going down, right? So all of these are part of capital structure. That's why it's so important to know this stuff.
Yeah. Thanks for. I'm excited about this because, we're getting pretty granular here. Some of our topics have been, hey, buy a 2-unit, hey, buy a multifamily, and then complicated like cost segregation I mentioned earlier. This is great because people don't talk about this vein, or they don't talk about it well enough to take something out of the interview. So just right now, identifying people that, hey, you might not be doing things right, and there's this hidden world is awesome. Love it that you play in this lane.
I got to tell you, I love the high level stuff, but the problem is the details is where people lose their shirt, right? And that's why I love to dive into details here and go into minute detail. It's because people need to know this stuff, right?
It's really important. Absolutely. So, George, what are the biggest mistakes would you say that investors, or you think investors do when creating capital structures? They might be creating them and not even knowing they're creating them. So
I would say if you think about capital structure as, let me think of an analogy, 3 dials. Think of a radio, or not a radio, but something that has dials, okay, in the car. So let's go back to a radio analogy. You have 3 dials, right? And you're controlling the 3 dials on the radio. So the first dial in a capital structure is how much debt, right? And if you have too little debt or too much debt, you're screwed. Okay. The second one is what's called the spread. And again, these are percentages. What percentage is debt? What percentage is for the spread? And most people don't even know that there's a spread in real estate. We'll talk about it in a second. And then the third dial is your reserves. How much reserves should you have? A lot of investors think, I don't have to have reserves. We'll talk about that in a second. So what happens is you have to set the right dials everywhere. So some of the common mistakes is they have way too much debt. In fact, one of the common things you hear people say, no money down. So no money down is awesome, okay? But if it's 100% debt, which is what most people do, you're asking for trouble. Because the minute the market starts going down, which we know will go down, it's just a cyclical nature, you're in trouble, right? And so having too much debt, the other part is not enough reserves. You have to have reserves. You have to have reserves. And we can expand on that a little bit later if you want. Um, your down payment, one of the common things people do is they buy a retail property, buy and hold with a credit card or with some debt. Okay, you have to know how do you offset that because that's 100% debt. And these are all common mistakes, and people hear about these things. They use them every day, almost like it's the right thing to do. And what they have to realize is they're taking on risk, and buying the property is the easy part. Keeping it through a whole cycle is the harder part, right? So as we know, once you buy 1, 2 properties, it's easy to buy these things. And you can close them all day long, but you're doing the same mistake and it's just propagating and increasing your risk over time. So you have to make sure you measure how much debt you use, how much reserves, all of that stuff.
So you haven't mentioned a bank or interest rates or anything like that yet, which is cool because it has I guess a little bit less of a meaning. But can you walk us through the process of putting together good capital structure and how that would look?
Yeah. So let me ask you guys this. You know the company Intel, right?
Mhm.
That does the chips. Okay. Who's the competitor of Intel?
I don't even know the answer.
AMD, right? AMD. Okay. So remember this: AMD, and then add the 3 other letters LSR. So if you remember these 6 letters, AMD, LSR, that gives you the process. So let me walk you what these mean, okay? So A is the asset. So the first thing you need to do is you need to get the information from the asset. What's the NOI? What's the rent? All of that stuff. What are the expenses? Get your NOI and get what's called the cap rate. So that's A for asset. MD, it stands for maximum debt. Okay, so I'm walking you through the 5-step process here, okay? MD is maximum debt. Now, what does that mean? So I want you to think about think of it 2 people. So let's just say, Jeremy, you and I are going to lift some weights, okay? And you're younger than me, you're stronger than me, you're going to be able to carry more weights, right?
Mhm.
So let's just say you're carrying whatever, 100 pounds, and I'm carrying 50 pounds, and that's the maximum I can carry. So every single asset can only carry so much debt. It's equivalent to a weight, right? So what you have to do is figure out what is the maximum debt that asset can carry. That's MD. Okay. So what you have to do is figure that out, and we can talk about how you can do that. But so A is for asset. MD is what's the maximum debt that asset can carry. Then LSR is L is for leverage. Once you know the maximum debt, let's just say the maximum debt is 82.7% debt is the maximum that this asset can carry. Then you want to have up to that or less, but not more. Now, what if you have to have more? Then you increase the reserves. We'll talk about it in a second. So L is how much did you decide with leverage? I'm going into a lot of detail here,
It's great.
but
I love it.
that's the thing. I want people to understand the importance of this stuff. S is spread. So now we'll talk LSR. L is leverage. S is spread. You have to have positive spread. So what is that? That means it's a difference between your cap rate and something called your loan constant, which I don't know if we'll have time to cover. We can cover it later if you have time. But you want that to be positive spread. What it turns out, most people that lost their shirt in 2008, they had negative spread, and they had too much debt and didn't have reserves. So let's go back to the last letter, R, reserves. So you have to have reserves. Okay, so let's talk about these things. AMD, LSR. A, get the asset information, calculate your maximum debt. L is figure out how much you're going to have in debt. So you know the maximum. You can go up to the maximum or less, but not more. But you have to know what to do if you have to go more. S is your spread. You want to have positive spread. Again, that's the difference between cap rate and the loan constant. I'll go into a lot of detail here.
It's great.
But R is reserves. You have to have reserves. And I cannot stress that enough. So that's the process I go through. And we normally teach that, but one of the things we're doing now is we're building it into software that we're going to be giving everyone for free, so that the software has built-in intelligence to help the user walk through this process of structuring these deals, because people cannot afford to be losing properties because they do everything right except the process, and that's so critical that they get it right.
That was tremendous, George. I do want to take a pause and talk about the loan constant concept real quick right here, since you touched upon that. I hear a lot of investors, and before listening to you speak and learning this from you a couple years ago, I fell into the same boat with the mistake. I've heard of spread before. I was looking at the cap rate versus the interest rate and thinking, if I have a positive spread there, I'll be fine. So they might know what a spread is, but they're calculated incorrectly, right? Do you mind explaining what that is and why that's so important?
Yeah. So think of a loan. So when someone is comparing or looking at a deal, when you're looking at what you want to make sure is you want to make sure you're making money off of your bank's money, off of the mortgage, right? And so what you want to do is if I asked you guys, if I could borrow money at if I could borrow money at, say, where it's going to cost me $3 a month, but I'm going to make $4 a month, I'll do it all day long, right?
Mhm.
So same thing with the cap rate and a loan constant. So these are relative. The loan constant is nothing more than your annual payment, or let's take it this way: your monthly payment, your PNI, not PITI, but just your PNI, times 12, divide by the loan amount, not the loan balance, but the loan amount. So let's take an example. If your PNI is $1,000 a month, you multiply by 12, you get 12,000. You divide that by, let's just say the loan is 100,000. Okay, that gives you, well, that's a bad example, but 12% loan constant, right? So what you want to do is you want the loan constant, you want to compare it to the cap rate. You want the loan constant to be less than the cap rate. Okay, and what does that mean? That means I'm borrowing money from the lender and I'm making more money than what I'm borrowing from the lender. The cost of money, essentially, cost is, I'm going to put in quotes here, is I'm making money off the bank's money. That's what's called positive leverage. The challenge, though, is for an investor to be comparing interest rate to the cap rate is comparing apples and oranges. And it's the worst thing you can do for any income producing asset. You have to compare the loan constant with a cap rate. Comparing to the interest rate is what the banks want you to do. So here's what banks tell you. They say, why get a 30-year loan that has more interest when you can get a 15-year loan that has less interest and you can be debt free in 15 years? What they just did was they just increased your loan constant. So what we want as borrowers, we want the lowest loan constant as possible because it's a lower risk for us. What the banks say is look at the interest rate over here, but what they're actually doing is they're passing on a higher loan constant to us because they're shifting the risk to us. So you have to know how banks think and how investors think. And loan constant is one of those things you have to do. So when we talk about positive spread, we're talking about the cap rate needs to be higher than the loan constant. And it's very critical that you do that. So that takes precedence over interest rate.
So I guess I'll throw this out there. There's a lot of money out there, and people don't know what to do with it. It's kind of sitting idly by. People are trying to put it to work in some way, shape, or form. What are your thoughts on that?
You mean when you say money, you're talking about debt or just money in general?
People have money to put out there. They're looking for projects. They're looking for. I mean, a lot of them might be smaller. There's people trying to get
Yeah.
into a 2-unit
Yeah.
or a 3-unit, and they're looking at a residential loan on these, and they're like, hey, it's only X percentage. How do you walk someone through something like that? Should they be doing something like this? Should they be trying to figure this out now?
They need to understand again. Let me give you an example. Here's what the typical investor says. The typical investor says, "I'm going to buy this property. And I don't care how I get the financing, I'm going to buy this thing. They're so focused on the acquisition and the ownership of the property that they're missing the thing that's going to sink them, which is how are you going to, what are the terms of this financing? And so let's take an example with a typical investor. They say, I'm going to get 100% debt financing. They're going to get, let's just say, an 80% loan, and they're going to borrow the 20% debt financing from someone else, from their HELOC or whatever. So now they have 100% debt financing. They don't understand when you buy something for retail like that, you're asking for trouble because you have increased your uncertainty. So the more debt you use, so we need debt to increase return. But at the same time, at some point it becomes the uncertainty goes way high, meaning the volatility, the uncertainty of the cash flow. Let me give you an example. Let's just say that both of you buy a 100-unit apartment building next to each other. You use 80%, you both use 80% first position. You go out and borrow the 20% as debt from someone else. So now you have 100% debt financing, but you own the property. Jeremy, on the other hand, has 80% a mortgage, but uses 20% equity financing. He says to someone else, I'll give you 50% of the deal, for example. Okay, now you both own the property. Let's just say they're right next to each other, identical in every way, identical profile for your tenants. However, Jeremy can afford to have 18%, I'm making up the numbers here, loosely speaking, economic vacancy. That means he can afford to have 18 people move out of the 100 to break even. In your case, you would have 6 people move out and you're in trouble. That's when you had to break even. Why? Because you had too much debt. So what happens is when I say the uncertainty, that means as you have more debt, you cannot afford to have too much fluctuation in your income. And so the person who has 6%, or 96% break even, or 94% break even, that means just 6 people move out and you're in trouble. Now, you and I know with apartment buildings, you always have to assume 5% vacancy rate. You're already in trouble. Okay? So someone might say, I lost the property, real estate doesn't work. Well, they didn't understand is they had too much debt. Does that make sense? So you have to structure the debt. So there's a lot of money out there, but you have to structure the equity and the debt the correct way. The same percentage is the right. Does that make sense?
Absolutely. Yeah.
So that's why it's so important.
Yeah, it's neat to hear someone talk about this. No one really does.
Yep.
It's kind of the beauty.
George, how do you measure the amount of reserves that you need or that you would want on a specific asset?
That's a great question. So let me first start by saying most investors think if I have money sitting in the bank, it's doing nothing, right? And that is the worst advice I ever got. So let me share with you why. So imagine you're building this huge building. You need very solid foundation before you build the building. Would you agree with that?
Yeah.
You're going to focus on the foundation and then you build. Now imagine once you build the building, you go back and you say, well, that foundation is underground. No one sees it. Let me suck it out and use it for the next building, right? What's going to happen? Well, that's exactly. So with debt, you always have to have reserves. That's the foundation of the building of debt. And so you want to have at least 3 months, and this is just a rule of thumb, 3 months worth of reserves. That means your mortgage payments and your expenses. So you add them up and you multiply by 3 months at least. Now, what I do is I have 2 types of reserves. I have the primary reserves and I have the secondary reserves. So secondary reserves backs all my properties and my different investments. And primary reserves is for every entity has its own primary reserve. So if you and I are business partners on an LLC, we have primary reserves, and then I might have other primary reserves for different entities, but I have a secondary reserve that backs all the primary. So for the primary reserves, we're talking about at least 3 months.
I thought it was going to be more than that or different, but I I do see a necessity for your software because I'm like taking notes and I'm writing things down. I'm like this equate. It's like calculus.
You know what? I have to tell you something. That's why we decided to build software,
Mm.
because one of the things I decided is I can keep teaching this stuff, but, and Jeremy will tell you, the same students show up 2, 3. I mean, these students are doing, some of them are doing 100 deals a year, and
Wow.
these are pretty advanced, and they're coming back, and we've saved so many people from disaster because of this information. And so what we decided to do is, let's just take this intelligence and build it into the software. So the software doesn't just give you, what's your return or what's this one, but it actually gives you some recommendations, points things out. So I was showing Jeremy yesterday a quick demonstration, and we just picked a random address. And one of the things it gave us is, are you sure you want to buy in this area? Because no, it detected that your cap rates in that area are low, which means you don't have enough income, but appreciation is low too. So whenever you buy a deal, you have to look at, am I buying for appreciation or am I buying for income? And the fact that they're both low, you cannot create spreads, positive spreads. Are like, wait a minute, are you sure you want to do this? And it just happened that we just picked a random property. But that's the advice that we want, not advice, but recommendation we want our software to do.
Hey guys, I hate to be impolite. I gotta go, but Jeremy's taking over. I'm gonna get the notes and buy the software.
The software is free, by the way.
Then I'm definitely buying it. As many. It's okay. No, really. Thanks, George. I'll catch up with you soon. Cheers, guys.
Awesome.
Thanks, Regis. Awesome. Good stuff. So, George, would you say we were just talking about the reserves and having money in the bank? So let's say an investor has $100,000, $200,000 in the bank. Would it be not wise to just go spend all that on down payments on a property or whatever investment that is? Would it be wise to actually keep those as reserves to then kind of leverage for more deals? What's your opinion on that?
I totally agree with you. I think keeping it in reserves and being able to put more deals. So here's what I would recommend for people that are so if someone's done number of deals and they're comfortable with the numbers, I would recommend that they keep the money there, because it serves as a backup in case, as we know, things happen and you might need to fix something. So reserves are really critical. But there's nothing worse than taking all your money, putting it as down payment. Now you have no liquidity, and the market goes down, or you have an issue in the property, and then you have to call your other investors and ask for money and all. In every way, it's disaster. So when you have reserves, you're able to raise equity financing. You're able to do a lot more deals, and you always have this, what we call secondary reserves, to back up any issues that might happen if the market's going down. You have to have reserves, all of that stuff. So it is so critical to have reserves and enough reserves. So again, 3 months is absolute minimum per property, and we have every month money coming out of investments go into reserves and adding to the reserves from the cash flow.
Continuing to protect your downside, right? I remember you saying that one of the first times I heard you speak. So many investors, and I was like this when I was younger, was just aggressive. You have money, let's go buy more, and razor thin reserves, if any, and you're just aggressive. And because the market's going up, you don't see the downside versus, you can be offensive, but also be defensive at the same time. What's your opinion on that?
I totally agree. I think you see, I mean, how much more aggressive can you be when you know you have the liquidity?
Mm-hmm.
Think about that for a second,
Yeah.
right? The problem is people cannot sleep at night when they have no liquidity,
Mm-hmm.
and they're buying all this stuff, and all it takes is the market going down or something happening to the building. They cannot, they don't have the reserves to fix it or whatever. And so we all know that things look great when things are going up,
Mm-hmm.
and everyone thinks they're a champion, and then things start going down, and they start running for the hills and selling properties and all that stuff. This is a long-term play, and with that comes knowing what to do when the market goes down. It's not a matter of if, it's a matter of when, right? Understanding how to deleverage your portfolio, all of that stuff. This is all critical stuff that people need to know. And it all starts with having enough reserves. So, and people can be extremely aggressive as long as they have the liquidity.
That's great. No, I appreciate that. So let's take this in a little different direction than George. Well, when structuring your investments, we talked about the capital structure, how important that is. What tools do you use when structuring your investments?
So I've always used my spreadsheets, but recently we decided to start building software, because with software, you can have intelligence, you can have the software grab data out there and give you better data to make better decisions. So now we've built one of the first websites we're building right now, or software, is called InvestZen. So it's investzen.com. We haven't launched yet, but we're going to be doing for free for everyone. And the idea is that people can go there and just analyze their deals and give us feedback how to improve it and things like this. We want this to be for everyone. And so we're going to be building some pretty powerful tools. We've had about 200 users right now that are giving us feedback. We just limited to just a few people, just 200 people. And so we have a lot of amazing tools, but when we launch again, we're going to just launch with one tool at a time. And but essentially, this is what I use right now, is InvestZen for analyzing things.
That's tremendous. So you mentioned earlier that you were doing a lot of teaching when you came up with the idea. Was that kind of the impetus of creating that?
Yeah. What happened is I realized there's so much information that one has to do when they're putting deals that sometimes you can't remember everything. So I'm like, why don't I take what I know and what a lot of experts out there know, put the intelligence into the software, so it does a lot of thinking for you and helps you with recommendation. Looks at the areas, looks at data, looks at, are my expenses correct? Am I analyzing for capital expenditures? Am I doing this? There's a million questions you have to be asking. What if the software helps you with that, so that it does a lot of the stuff in the background for you? And so I decided it's really time for us to really take things to the next step for investors by building software that does a lot of intelligent things, right? There's a lot of good software out there, but a lot of it is just analysis where you have to know how to interpret the data. And you have to understand, what does a DCR mean, right?
Yep.
But what if you have software that takes it to the next level and 2 and 3 and looks at all aspects of your deal, right? And says, hold on a second, you don't have a good, solid power team. Your power team, you're missing this and this. Or what if it can help you generate a story? You need a story to share with your investors. What is the story that's compelling, that gets your investors to say, yes, I want to invest more? So having software that does all of that stuff is very critical. So I'm just using my background in working at Intuit, on Quicken and Quicken Financial Planner and all these other software that's out there and been number one in personal software out there. I'm using all that experience to put into this with my understanding and my experience with real estate to build something for everyone. And again, we're going to just do it for free, so people can start using it.
It's tremendous. It's like you said, there's so much out there. There's sometimes I have like 8 spreadsheets open doing different things, right? Having everything, and that's just the calculations, not even the marketing, not even all this, right? Having that all in one place would be game changing. Yeah.
Honestly, that's what we want to do. So we recommend to everyone, add your name to the list and to the waiting list, and we'll just let everyone know when it's out and get you guys on board.
That's awesome. So if anyone's interested in being added to the list, how could they do that?
So just go to InvestZen, Z-E-N, so investzen.com. And I'll just tell you, though, what I showed you yesterday, Jeremy, was almost quite a bit of stuff. We're actually going to start from scratch. What I mean by that, we're going to switch everything off,
Mhm.
and we're going to start with one module. So every 6 to 8 weeks, we're going to release one module and one tool that is self-contained, that is very powerful. And the idea is to have new releases every 6 to 8 weeks, so that all our users know how to use every single tool in the most optimal way for their deals.
Mhm.
And so, so just go to investzen.com, check it out, add your name, and hopefully we should have it up and running in next few weeks.
That's tremendous. No, that's awesome, George. So, George, I like to ask this question at the end to all our guests. So, what daily habits do you keep that you attribute to your success?
Coffee in the morning. In my morning, when I first wake up, I don't like to talk about business or read emails, or I like to enjoy the first hour of my morning. So in the first hour, I grab my coffee, and I love to chat about anything and everything that is sometimes senseless, doesn't matter, but just something fun, something exciting, something positive. And so I either do that with my family or with my staff,
Mhm.
and that become like a ritual that everyone knows. George, for the first 45 minutes to an hour, don't talk about business, okay? And what it does is it starts me off on a good note, and that's really part of my one of my routines. Let's see what else. I think that's about it. I mean, I have a lot of small things I do here, and
Yeah.
I'm big into organized desk. I don't like to see clutter at my desk because it affects my work. So first thing I do in the evening before I leave to leave the office, I like to get everything organized for the next day.
Mhm.
So yeah, so that's just some stuff.
Oh, that's great. No, thanks for sharing that.
Yeah.
So, in closing, George, how can our listeners get in touch with you or find out more about what you're doing? Is it just going to the Invest Zen website, or is there anything else that you want to share?
Yeah, investzen.com. Just sign up there. You get a free account, start using the tools, give us feedback. If you're interested also in go to amazon.com. You can Google or search for my name, George Antone, and see one of my 3 books there if you're interested in this topic. But I highly recommend you sign up for InvestZen. Again, our whole goal is to build this for everyone so we can all benefit from it. And we'd love to hear your feedback, how we can improve it, any tools you're looking for. But I can tell you that some of the tools we're building right now and we already have, you've never seen anywhere else. So we're pretty excited about that.
That's tremendous. No, we'll add those links to the show notes just if anybody's interested. I read all 3 books; they're tremendous. So I just want to say that. So, George, thank you so much for your time today.
Thanks, Jeremy. I really appreciate you guys having me.
Perfect. Everyone, this is George Antone with Finance. I'm Jeremy Moyer with Real Estate Investor MBA. Please tune in next time. See you then. Thank you.